Ladies and gentlemen, how y'all doing? Mike the CPA here. In today's video, we're going to be covering the most complex new tax deductions for business owners, and that is the QBI deduction, or the Qualified Business Income Deduction, also known as the 199A deduction. Now, learning all this stuff throughout the course of this year in 2018 was borderline torture. But now I get the privilege of being able to torture all of you out there in the land of the internet
with all this new, juicy tax knowledge.
This is going to be a two-part series, guys. So in this first part, we're going to cover this in great detail, all the theory, the rules, what this deduction's all about. And then in another separate video, I'm going to have an Excel document with 5 full-on step-by-step calculation examples that literally took me hours to put together, that I'm going to be showing to you guys in the next videos of this series. I'm going to have a link to that video down in the comment section down below, and also in the description section of this video, so make sure to be looking for it. And without further ado, there's a lot to cover here, so let's go ahead and dive right into it. Do you remember when you were back in math class and you had to learn an entire new section or entire new chapter on math that was completely different than the previous chapter? Do you remember how hard that was? Well, that is kind of like what this deduction is. It's a whole brand new frontier of tax, and it's really different than any other area of tax. So you really have to think of it in that way. It's a whole new set of rules and a whole new way to think about things. So you really need to take the time to wrap your head around it to understand it. So let's go ahead and get started, and I'll keep this video as short and concise as I possibly can. So this new 199A deduction is stemming, of course, from the Tax Cuts and Jobs Act, right? The Tax Cuts and Jobs Act was signed into law on December 22nd, and along with this came the provision section 199A. These new tax savings are huge. Imagine you're a business owner, and imagine your taxable business income is $100,000. Now, we know that the max deduction you can get is 20%. Now, pretend I came to you and I said, hey, Mr. and Mrs. Business Owner, of your $100,000, guess what? Because of these new tax rules, $20,000 of that is no longer subject to federal income taxes. That is how powerful these deductions are. Now let's discuss the more formal definition of this. So for the years beginning on January 1st of 2018, all the way through December 31st of 2025, this deduction is going to be in play. And basically what it means is a taxpayer other than a corporation, got that? So if it does not account for corporations, is entitled to a deduction equal to 20% of the taxpayer's qualified business income. So qualified business income is defined as the net amount of qualified items of income, gain, deduction, and loss with respect to a qualified trade or business that is effectively connected with the conduct of a business within the United States. One of the things that is going to affect this deduction is capital gains, whether they're long-term or short-term, but you guys will see that later on within this video. In terms of qualified business income, an area of caution is rental real estate income. The IRS has not ruled one way or the other, or have provided guidance to let us know if they're going to count that as qualified business income, which is really unfortunate since we're getting close to the end of 2018 at the time I'm filming this video. Historically, courts have ruled in different tax cases in the past that even the ownership of a single rental property could constitute or qualify as a trade or business. You know, it's up to you as a taxpayer to take the position you want to take on this. I'm expecting we're going to see more guidance, but just keep that in mind, whether you want to account that rental income as qualified business income or not on your 2018 tax return. Let's talk about now what is not qualified business income. What is not qualified business income? And that is dividend income, any interest income, net gain from foreign currency transactions, income from national principal contracts, amounts received from an annuity. A really important item to point out here on this list of all of them is compensation or wages. So your wages, whether they're from your job or whether you pay yourself wages from your own business, they're not going to be factored into your QBI income. They will, if you own your own business and pay yourself wages, they will help factor into your QBI deduction, but it's the wages you pay yourself are not going to factor into your overall QBI income. But a lot of people are asking if it's going to add to your income for QBI purposes, and it's not. Also on this list, as you guys can see, is guaranteed payments. Guaranteed payments are not included in QBI income calculation. The reason this is important is because obviously people want to have as high of a qualified business income as possible for this deduction, because the higher amount their business income is, the higher the potential deduction they could possibly get. So that's why it's important to know what items do not factor into qualified business income as they're listed here. Let's continue. This one kind of came as a shocker to me, but the question was, do I need to be active in order to qualify for this QBI deduction? And the answer is no. At least that's how I understand it, unless things change. But so to the best of my knowledge, the answer is no. You do not have to be active in the trade or business in order to qualify or receive the deduction. The 199A proposed regs indicate that the taxpayer's level of involvement in the business does not matter. If they meet the requirement of IRC Section 199A, they may be entitled to the deduction whether they are passive or active within the business. So that's pretty cool. Now let's discuss some of the limitations of this deduction. The 199A deduction is limited to 20% of the lesser of qualified business income or taxable income after reductions for any net capital gains, short-term or long-term, but before the 199A deduction is taken into consideration. So I know it's confusing, but just take your time to study that and wrap your head around it. We're going to look at one quick example here right now so you guys can understand what we're talking about. In terms of taxable income, this piece right here, remember your taxable income is generally your adjusted gross income minus your standard deduction or itemized deduction if you itemize. So your AGI minus standard deduction or your itemized deduction equals your taxable income. Okay, let's look at a calculation example and let's see if we can make more sense of all this stuff, because it's very confusing when you read it out loud. I had to read this several times to follow it. Okay, we have our calculator on screen now. Now let's look at an example and put these rules into place. So we have a taxpayer, married filing joint, with a $100,000 of qualified business income from their business. So that's $100,000, right? That's $100,000 of income right there. So we're going to add $100,000. Then, this same person, they also have $100,000 in long-term capital gains. So we're going to add another $100,000 here. So now their total income before deductions is $200,000, right? So now they have $30,000 of tax deductions. Let's just pretend these are their itemized deductions. So now, from this $200,000, we subtract $30,000 from that. So this means their net taxable income in this example would be $170,000. But now we have to apply these set of rules or this logic in order to calculate our deduction. Okay, so it's 20% of the lesser of either qualified business income or taxable income after reduction for any net capital gains. When we first come down here, we see that their qualified business income is $100,000, correct? So we know what that is. But now we have to look at it from the other angle. So we know our net taxable income is $170,000 because we just added all this stuff up and then took out the itemized deductions. But now we have to back out long-term capital gain. Remember, it's taxable income after reduction for any net capital gains. So we take $170,000 as we have here, and we subtract out the long-term capital gains of $100,000. So now, this is our net taxable income after capital gains have been taken into account. So now, which number is smaller? The $100,000 of QBI or this $70,000? Well, if you passed math class, which I hope you did, you know that $70,000 is the right number. So the $70,000 is smaller. So that is the number that we have to use in order to find out what our qualified business income deduction is. So we're going to take $70,000 and we're going to multiply that by 20% because that's the max deduction we can receive. So our QBI deduction in this example, the result is $14,000. So this taxpayer can reduce their taxable income by $14,000. And where you're going to see that show up, and because I've looked at the 2018 draft forms, it's going to be on line 9 if I remember correctly, and I'll put it up here on screen, and it's going to reduce your taxable income even further. I know I went over that example pretty fast, but like I said, you're going to have this handout you can download for free, and you can rewatch this video anytime, so take time to study it. That's the best way you're going to learn this stuff, is to actually sit through it and work through problems for yourself if you really are hoping to understand it. Because I don't think there's another way. It's like math class. You really do have to work problems out to understand how this all works. So what businesses and taxpayers qualify for the 199A deduction? So we know that if you're a partnership, you're eligible. If you're an S corporation, you're eligible. Now, remember I said corporations are not able to take this deduction, but I meant C corporations. If you're an S corporation, which means you're a pass-through entity, then you are still allowed to take the deduction. If you're a sole proprietor, so like let's say you have a lawn mowing business and you just work for yourself, well then your business would also fall under this category, so you would be eligible to take it. Or if you're an ag cooperative, you can take it. Other eligible taxpayers include individuals, trust, and estates. On that note, now let's talk about the people who don't get to take it. Remember, C corporations do not qualify. If you are an employee, I have to make this very clear because a lot of people ask about this, you do not get the deduction. To qualify for this deduction, you have to have ownership interest within a business. So what is a qualified trade or business? That is a question you should be asking yourself. So every business is a qualified trade or business as defined under Section 199A, with the exceptions being the trade or business of performing services as an employee. Sorry, employees, you get screwed. And a specified service, trade, or business. Sorry, service businesses, they don't like you either. Before we get into all of that, let's talk about some income limitations. If your filing status is single, you get the full 20% deduction if your taxable income is less than $157,500. If you're married, filing joint, you get the full 20% deduction as long as your taxable income is less than $315,000. And once you go above these amounts, then the deduction starts to phase out for you. So no deduction once your income exceeds, if you're single, $207,500. So, which is a $50,000 spread right here. That's what this is a $50,000 spread. And now if you're married, you have more room here. It's actually a $100,000 spread. So as long as you're within this range, you can still take the deduction. I want to make it very clear here that if you're in a specified service business, which we're about to cover here in just a second, then once your income is above this, then you can no longer take any deduction for 199A. So once you're over these amounts, you're out of luck if you're in a certain specified service, trade, or business. But if you're like a manufacturing company or another kind of business that is not a specified service, trade, or business, you have some more leeway, you have some more options, even if your income is above these amounts, which is pretty cool. So then there's another test. It's called the income limitation phase in. And so that they look at the limit is the greater of 50% of your W-2 wages or 25% of your W-2 wages plus 2.5% of your unadjusted basis. This, I'm going to tell you, is not going to make a lot of sense right now until we actually look at a full-on examples of this in the next part of this series in Excel that we're going to do in the next video. I'm going to let you guys read this part for yourself on screen. I don't want to read every single line item to you guys for sake of time, but I'm explaining how there are exceptions for deductions if you're in a specified service, trade, or business. So go ahead and just take your time and read this for yourself, and it will make a lot of sense. Now, let's get into the important part of what the heck is a specified service business. And the acronym for these things, guys, there's two acronyms out there, and the acronyms are SSB or SSTB. And I know what you're thinking. I know what you're thinking when I said that, is you're thinking of STD. And it sounds just like it. Well, specified service businesses, or SSB or SSTB, are bad. So if you work within one of these types of businesses, this deduction is not your friend. It's not as friendly to you. So just like STD is bad, if your business is an SSB, it's bad, because there's limitations to the deduction you can take. And that's kind of how I remember some of this stuff. I know it's crazy, but it helps. These new rules are bonkers.
Let's go bonkers. Yeah, totally nuts. Bonkers. No ifs, ands, or buts. Bonkers. Someone's stealing the show. Casey, I gotta go. No.
Now let's look at some examples of these SSBs, the specified service, trade, or business. If your business is in the field of law and you are engaged in the performance of legal services by attorneys, paralegals, and other similar professionals who serve in a legal service capacity, you're an SSB. If you're an accountant, hey, that includes me. Accountants, auditors, enrolled agents, and other similar professions are considered service types of businesses. Doctors, pharmacists, nurses, those are considered services. Performing arts, actors, singers, directors. For all of you out there who are aspiring to be famous YouTubers and make a living off of YouTube or extra money from YouTube, unfortunately, YouTube, based on my interpretation and this definition, would fall under this specified service, trade, or business category. So your deduction might be limited. So I'm going to stop reading this list. You guys can read it in your own time, read through it. There's a lot of different professions that would fall under this category as specified service, trade, or business. So now that we've looked at some examples of that, there's one more thing now that will make a lot more sense. Let's go back up to this income limitation thing, which we were talking about up here. So whether or not you're in a specified service, trade, or business, or a different kind of business altogether, the good part is as long as your income is below these amounts, which this is going to be true for most people. So most people are going to be able to get the full 20% deduction. So if you're single, as long as your income's under this, and if you're married filing joint, as long as your income is under this amount, you're going to be able to get the full $199 EA deduction, whether you're in a service business or not. So that's the good news. Once your income goes above these amounts, if you're in one of those specified service, trade, or businesses, which we discussed down here, that's where your deduction completely stops. You get no chance of deduction after that. But if you're in a business that is not one of these things right here, if you're like a manufacturing company, then there's some other tests you can run under these income limitation rules that might allow you to actually get a deduction. So I hope that makes sense. I know it's confusing, but it's going to make a lot more sense in the next part of this series. We're going over the theory here, ladies and gentlemen, so that when we do the calculations, the numbers will make more sense. Because if you don't know all of this stuff, all of these rules, the calculations will make absolutely no sense. So that's why we're covering this first. In the handout, take the time or pause the video here to read more about specified service, trade, or businesses. I'm not going to read all this to you for sake of time. All right, I think I'm going to go ahead and stop the video right here. I know I went over a lot of information very quickly. Remember to download this handout for free. It'll make a lot more sense. I think you're going to get a lot from just rereading the handout. Watch this video again and go through this calculation example up here that we covered just to whet your appetite. And then next week, in next week's video, I'm going to publish 5 full-on calculation examples. So it's very important you study up on this. Think of this as a class. Your homework, ladies and gentlemen, is to read up on this, download the spreadsheet, and study this, and then I'll see you again in next week's video. If you liked the video, drop a like. Make sure to share this information with a friend, especially a friend who's thinking about starting their own business, or a friend who already has their own business. I'm sure they would find this information helpful, because this is a new frontier of tax, and CPAs and professionals are trying to learn this, as well as business owners. And if you're new to Money in Life TV, welcome. On this channel, our goal is to help you become fiscally fit, and we do that by teaching finances, investing, taxes, and more on a regular basis. So be sure to subscribe so you do not miss any of our future uploads. If there was ever a year to find an accountant, if you're a business owner, this would probably be the year to do it. if you have a complex tax situation, is to find out seek out a CPA in your area who knows this stuff very well. All right, ladies and gentlemen, I really look forward to reading your comments. I hope you have a great week, and I will see you in the next part of this series. And then I think it's going to start to make way more sense. But until then, do your homework, don't let me down, and I'll see you in the next one. Love you all. Peace.